Okay. All right. Good evening, everyone. Welcome to our Oklahoma State Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thanks so much for checking into our Zoom session for tonight. This is a class that we put on 4 times a year for the Oklahoma State Alumni Association. Really excited that you guys get a chance to be a part of this with us. This is a very interactive class that we provide to you. So, we hope that you're going to learn a couple things that can help you on that goal of homeownership whenever that timeline works with you. A lot of great things to share with you in tonight's session for us to be able to kind of pass along some information to you. We've had the pleasure of helping several of your fellow alum earn or really achieve home ownership across the country. Many of which those relationships that we have in our community started right here in our class. So we're excited to help teach you up on all these great things that come along with home ownership, give you some market insight, and then hopefully have a couple things to think about as you plan towards home ownership. Well, again, my name is Jason Maida. It's a pleasure to be with you this evening. I'll be your presenter this evening. So I'll be watching Q&A and some of the chats that come in for different questions. Love to be able to answer those on air. And then later on in tonight's class, we'll carve out a little bit of time to answer any follow-up questions that you might have. Our organization is called American Pacific Mortgage. And like I said, we're in partnership with the Alumni Association to bring educational courses like this to our local communities. So this is a national program that we provide here. Our team in particular specializes in supporting our alumni communities with different homeownership tools and resources that are available to you. Now, in our classwork that we do tonight, there's quite a few talking points we're going to run through. The runtime for tonight's class is just a little bit less than an hour, but we're going to weave in questions that come in from our audience as we go through tonight's class. We are recording tonight's class as well, too. And we're going to share back all of our content from tonight to those that signed up for the email class. So, signed up for the class via email. So we'll get that pushed back out to you as well. So a lot of great things to cover tonight. So let's dive right in. Talk a little about some of the highlights for tonight's class. We will spend some time talking about the housing market, what happened with interest rates today, and what's going on currently in the kind of the geopolitical but global climate with what's kind of happening around the world. But we'll spend some time talking about what's happening with interest rates, what's going on in the housing market across the country. We also will do a rent versus buying scenario. So we're going to talk a little bit about what does it look like if I continue to rent versus what could it look like if I decide to purchase a home. We'll talk about tips around credit to help you have the most inexpensive financing options by driving credit scores higher. That will enable you to do that. So we'll give you some tips and some tricks around credit building. We'll also talk about different programs that are available to you as first-time buyers. And then one of the challenges that we seem to have in kind of partnering with clients in building their home buying plans is just kind of saving up enough for home ownership. So I'm going to walk you through a savings plan tonight, as well as some different first-time buyer assistance resources that are available in your local communities. And the last thing we're going to talk about tonight, which is honestly probably one of the most important things, is where do I go from here? So after attending tonight's class, we're going to walk you through the home buying process. So I leave from class tonight. Hopefully I have a couple good takeaways for me. But what does it look like now to get on that path towards home ownership? All right, so that's our plan for tonight. Really excited that you guys could join us for this evening's session. And let's dive in by talking a little bit about, does buying make sense for me? Now, this is probably going to be one of the biggest financial decisions you decide to make. So I know everybody that's coming to a class on a Wednesday night like this, obviously you understand the importance and kind of the magnitude of making a big purchase like this. There's a lot of great benefits that come along with owning a home. Things like better affordability, because if I have a fixed payment as a mortgage, I don't have to worry about my landlord maybe increasing my rent. Some of our clients that are purchasing in today's market will have the opportunity to lower their payment at some point through refinancing of their home. So those are conversations we're having on a daily basis with our clients. And this is an asset. This asset can grow over time. So as I purchase my home at a certain value, that home goes up in value. I'll pay down my mortgage balance every month when I make my monthly payment. Well, the difference between my mortgage balance and what my home value is called home equity. For most of us that are homeowners, that's our number one asset that we have aside from maybe a retirement account. So it's a big deal when we have that, as one of our assets in our portfolio. And there's also some really great tax benefits that come along with owning a home, even tax benefits around interest for mortgage, also potentially energy efficient upgrade deductibility benefits too. So Those are really important things that we want to factor into homeownership that maybe we don't always think about when it comes to, making this a goal of ours. To kind of frame that up a little bit more for you, I thought I would walk you through a rent versus buying calculator. This is an exercise we take our clients through during one of our sessions that we do for a consultation. And I'm going to screen share with you the rent versus buying calculator because I think it's a really important way to better understand homeownership a little bit further. When you think about tax benefits, like I just mentioned in homeownership, equity appreciation, all of those really important things that make up homeownership, a calculator like this will kind of help you kind of figure that out a little bit more. And so if we look at our calculator here, we kind of pre-filled this out for tonight's discussion. But if we assume we're going to go out and buy a house for $275,000, the minimum down payment is 3% for a 275 purchase. Now we're going to talk more about what kind of minimum down payments and assistance programs exist. But for a conventional loan as a first-time buyer, it's a minimum down payment of 3%. That assumes that we would finance 97% of the purchase price. We have interest rates, the term of my loan, which would be a 30-year fixed mortgage for most of us. And then we'll make some assumptions on when I'm going to buy. So this just assumes next month. And then when we put less than 20% down to purchase a home, there's a thing called mortgage insurance. And so I'm going to spend some time talking to you about mortgage insurance and what it means to you as a buyer. But we want to factor that into the equation. We have homeowners insurance, taxes. If you're deciding to purchase a condo, maybe a townhouse, we want HOA dues factored into the equation. And then for our current financial situation, what tax bracket am I in? That's going to influence tax deductibility benefits of owning a home. This is a home that I'm gonna have to keep maintenance on. So I want to build in some expenses for maintenance that I have. Eventually, I'll probably sell my home. So there's selling cost to my home, right? And then appreciation. And appreciation looks a little bit different in different parts of the country. We may see, parts of the Midwest appreciate less fast, a lesser pace than I should say than maybe West Coast homes or East Coast or whatever the case may be. But we factored in 3% appreciation, assumed one of our buyers is spending $1,500 a month in rent with renter's insurance, rent going up on an annualized basis of 2%. Okay, so that's all of the ingredients that go in both to the buy side as well as the rent side, right? So if we kind of look at the output of our calculations, our break-even point of owning a home versus continuing to rent and probably paying somebody else's mortgage payment, the landlords, right, is about 3 years. So that means I will break even in home ownership at the 3-year mark based upon the investments I make of down payment and closing costs. And then the upside of equity appreciation and tax deductibility benefits, my break-even point is 3 years. That's a really good mark. Our benchmark that we like to have clients hit is at least 4 years or less in break even. The more you're paying in rent, higher like tax bracket you're in, more affordably you're buying, you're probably going to have better numbers when it comes to the break even point. Now, where I think it gets a little bit more exciting in a calculator like this is we were to take and span out an additional 7 years. So let's go to the 10-year mark. Where am I at financially? Well, at 10 years, now I've seen more equity appreciation. Maybe my income's growing a little bit, but ultimately my home possibly has gone up a little bit. I am reaping some tax benefits. My gain opportunity of owning versus renting it after 10 years is now $84,000. That is significant for many of us. And so I think when you're thinking about home ownership versus renting and making that jump into home ownership, this is a great calculator to kind of help you understand a little bit more about what the wealth opportunity really is for you. And of course, affordability at the same time. If we get a chance to do a consultation together, which I'd love to do with you, that's a one-on-one virtual session that we do with our clients. We'll walk through that rent versus buying calculator because I think it's a really helpful exercise to take you through. As I mentioned, for those of you that tuned in a little bit late to our class, we're going to send out all of our presentation material tonight. So calculator, like I just shared with you, that'll be in our presentation slides that we send out tomorrow morning along with the recorded version of tonight's class, okay? Now, as we're thinking about the timing of jumping into the housing market, what's going on with the housing market is going to play a role on when I do decide to take the plunge, right? Now, we're going to look at the Oklahoma housing market tonight. I know many of you are joining us from different parts of the country, and that's totally okay. I'll give you some generalizations of the housing market right now because we are in the spring season of buying. Also, that includes we have the summer buying season, right? Generally, the more kind of faster paced part of the market, or the more activity we see in the market, is usually running from the latter part of March all the way through August. Generally, most parts of the country, that's the warmer times of the year, right? You're starting to see sellers, they're going to put their homes on the market. Buyers are getting a little bit more active. That's for a variety of reasons. Maybe they want to move to a certain community because of a school district. Maybe it's a job relocation, whatever the case may be. But usually we see kind of a little bit more activity levels picking up in that latter part of March and through August. The market has really been needing supply, and there just hasn't been a lot of supply in the last couple of years, in most parts of the country, I should say. States like Texas, Colorado, Georgia, Florida, those all have plenty of supply. In fact, those are the highest supply numbers across the country. You can look at, the Oklahoma numbers we have on screen here, which is 73 days average days on market. So that's not terribly far off of what we're seeing in other parts of the country. So usually a couple months of inventory. We still need more inventory right now to supply the buyer demand. And we're going to talk about interest rates in just a bit, but as interest rates start to change and hopefully we see them go lower, more buyer demand will pick up. And so we really need the supply to help support what buyers need out there at a market level. At the same time, new home builders are trying to fill the gap and trying to build as quick as they can. But guess what? Cost of construction is expensive. So it's expensive to buy a home. You see many new home builders basically having a buyer make a reservation, and then they have a shorter build time. Maybe it's 2-3 months. Very unlikely that you're seeing builders build out with a 10 to 12 month build plan, because the carrying costs are just so significant for them. But those are things that are happening in the market right now. But I think interest rates ultimately are going to drive kind of the behaviors in the marketplace. Today, as I launched into today's class, I mentioned to you that we did have some announcements on kind of what's happening in interest rates or in the general economy. Federal Chair Jerome Powell spoke today. Didn't do much to help the markets today, I will say. We saw interest rates start to climb up a little bit. There's two major indicators that the Federal Reserve is watching. They're watching what's happening with inflation. There's a 2% goal for the economy to get to inflation. We're seeing some kind of up and down indicators on inflation right now. I think we're running at 2.3, maybe 2.4 higher in inflation. So that's still a little bit of a concern. And then we're looking at employment numbers. And employment numbers just a week and a half ago were not good. And so normally that would take interest rates lower, because bad news generally means good news for interest rates. But, we are in the middle of the conflict in the Middle East. And so because of that, we have this kind of cloud over really the usual economic indicators. We really don't know how that conflict is going to impact the overall U.S. economy. So there's a really bit of an unknown kind of situation right now when it comes to interest rates. One of the metrics we're watching, unfortunately, right now is the cost of oil per barrel, which I think finished up close to $97 a barrel. It's double the prices of what it was prior to the conflict. And so that's really kind of masking a lot of what we're dealing with from an interest rate perspective. So February 27th, interest rates were below 6% or just touching on 6%. Right now, as of today, after Jerome Powell got a chance to speak, interest rates have now kind of ballooned up to about 6.3, 6.4%. So, I think it's going to be a little bit of a volatile market right now as we kind of figure out what's happening both here domestically, but also obviously the impact of oil prices globally and kind of what's that doing across all markets. This is a 20-year snapshot of interest rates and kind of what we've seen over the last 20 years. And I think that's important to kind of frame that up for yourself too, because interest rates do cycle over time. And we, believe it or not, we're actually going into, we're a downward pressure on interest rates. We'll have these little bumps along the way, but interest rates are not as high as they have been. 2 weeks ago, we were at 2-year lows in interest rates. We're not there yet because of what's recently happened, but you can see kind of the recent activity in interest rates. And then I always like to share with clients and attendees of our classes, like what has happened most recently that you can think of with interest rates. Well, this gray bar here represents the pandemic. And you can see interest rates reach all-time lows eventually, dropping like 2.5% on the 30-year fix. That's probably not something that ever would happen again unless we really have a major issue globally like we did as part of the pandemic. But I think as we think about average interest rates throughout the years, they're going to settle right around the high 4s to low 5s. That's typically what we've seen. So certainly we're at above average levels right now, but interest rates will trend down. I think, again, we're just in this kind of this volatile space right now. Our projections are still for interest rates to go lower. I don't think it's an if, but more of a when type of situation. This is the last 12 months. So you can see we were really excited right here. This is February 27th, and then we kind of had this uptick here. So that's kind of what we're dealing with. We're still on par with what we've seen in 2026. So we're not hitting the higher levels that we saw in 2025. So we're still in a decent space, but I think we just kind of fell off the tracks a little bit of what we thought we were going with interest rates. Now, interest rates for our buyers it's not the same for everyone. Elements like credit score and eligibility for a loan product, loan programs, how much you decide to finance, what your down payment looks like, that can all play a role in an interest rate, as well as things like discount points. So you do have the option as a buyer to bring additional funds out of pocket. We call those points to help bring down your interest rate. Generally, 1 point is the equivalent of 1% of my loan amount, and that'll generally drop my rate about 0.25%. Now, term can also influence my interest rates. So the shorter my loan term is, the lesser the expense is going to be for interest rate. So as we get a chance to meet with our clients and figure out what the right home buying plan looks like for you, whether it's a 30-year fixed mortgage product or a 20-year fixed product, we're going to figure out the right design for you. But for the most part, our first-time buyers are going to elect a 30-year term because, let's face it, that's going to give you a longer period of time to make your mortgage payments, give you the most affordability options available. All right, now one of the things that plays a role in your product selection and interest rate is credit, right? So we want to give you some tips and resources to better help identify areas of opportunity on your own credit score. Now, every loan product does have minimum credit scores, and you can see that on screen. The lowest credit score we can go down to is 580 for an FHA loan, which is a government insured loan. We're going to talk more about kind of the particulars of each product in just a bit, but we do look at all three agencies' credit reporting. So there's Equifax, there's TransUnion, and Experian. So they all report out different scores. They also have different risk factors that are built into their credit models. And you probably didn't know this, but there's actually 3 different models to credit scoring. There's credit card model, there's auto financing, and of course, if you're going to apply for home financing, there's the mortgage model. So in a little bit, I'm going to walk you through the mortgage model to help you identify those areas of opportunity for yourself. We always take the middle credit score of all 3 agencies that report out. So if your highest score is 760, let's say your middle score is 740, and then your lowest score is 720, we're going to take that middle score of 740 when it comes to qualifying. Now, if you're applying with your partner, and let's say your partner has a 700 score, middle score is 680, and then the lowest score is 660, then we have to use that 680 credit score for qualifying because we always look at the lowest middle credit score for both borrowers. Okay, so that's the way that looks. There's going to be areas of opportunity for you in your own personal credit score when we think about credit utilization or, the activity that I have of opening new accounts. And I'll take you through that in just a bit. But I do think it's important to understand that when you do have negative items on your credit, the impact to your score will be in the most recent 12 to 24 months from the date of the event. So if my student loan came out of forbearance in October and my payment was due, and I forgot to make that payment and I got a 30-day late reporting, that 30-day late is probably dragging my credit score down a little bit right now. But as I show more on-time payments, as I move further away from that late last payment, I'm probably going to see some recovery in my credit score. Now, that image of the late payment will stay with you on your report for longer. In fact, it's 7 years or less. But how it impacts your credit score is in the most recent 12 to 24 months. I got a question yesterday from one of our clients about a mortgage inquiry, which, by the way, we only do soft inquiries when it comes to applying for your financing. But the question was, if I do an inquiry for mortgage and let's say it's a hard inquiry, how big of an impact will that have on my credit score? And it really is to be determined. So we don't really know how, the impact of one inquiry will, hurt your credit score. But, if you have multiple inquiries from different industries, you're probably going to see a bigger impact in your credit score. There are rules in place for auto financing and mortgage financing that you have a 30-day window of time to shop around with as many lenders as you want. And it's the equivalent of one credit inquiry hit to your score. Okay. So if you do decide to shop around for home financing options, that rule is in place. But again, as we design options for our clients, we only start with a soft credit check. And the reason why we choose to do that, because many of our first-time buyers, especially ones that attend classes like this, we're not ready to buy in the next couple of weeks, maybe even the next couple of months, maybe it's a couple of years down the road. So we want to give you all the tools and resources to understand home buying without negatively impacting your score. Now, here's the mortgage credit model for you so you can get a chance to understand that a little better. 15% of the model is based upon how long have I had credit. So the more active I've been with credit, the more accounts I have established, I'm probably going to have a higher credit score. 20% it goes back to what we just kind of talked about around hard inquiries. So am I trying to obtain more credit? That's going to impact my score. Am I trying to open up new accounts that appear on my credit? We really want to limit not opening a bunch of new accounts because that could also put an impact to my credit score. And then this is generally the area of opportunity for most buyers that I work with across the country, which is revolving debt and managing down revolving debt. You may have been, tapping into more of your credit cards recently, maybe because it's a trip or, maybe it's, carryover from holiday expenses, whatever the case may be. But utilization of credit is usually the kind of the low-hanging fruit or area of opportunity for most clients. So if I have, let's say, $8,000 worth of balances right now, but my total aggregate limits are $10,000, currently I'm at 80% utilization of the credit. When you look at a profile like that, we probably see a lower credit score just because we're now exercising a lot of the available credit to us. Our first kind of like action item would be to try to get those balances to 50% utilization or $5,000 of balances. That will give us a little bit of an uptick in our credit score. Once we've kind of got there, we want to get to 30% or $3,000. That's a better credit score level. Ideally, or the optimal level is 10% or less. If you look at one of your credit card statements tonight, when you have some time, take a look at the two dates that appear on that statement. One is the billing cycle date or statement date. The other is the due date. What I would encourage you as part of one of your takeaways tonight, try to pay down your accounts before the end of that billing or statement date. Because what happens is when that statement date closes, the credit card issuer sends out all your activity information to the credit bureaus, including balance, charges, all that fun stuff, right? So in doing that, if you can pay that ahead of that statement date closing out, then you're going to get a much lower balance that appears. In turn, lower utilization, much more improved credit score. All right, so that's around utilization. Last component, those are going to be more kind of our historical payment history. We're looking at how have we paid our bills. If we've had any late payments, they're going to be rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. Obviously, the more significant the number of late payments I have, the bigger impact I'm going to have to my credit score. All right. Now, one of the things or the accounts that do show up on our credit reports is student loans, right? And so some of you in class may have student loans, you may not. But if you do, it shouldn't be something that prohibits you from looking at home buying options. So I wanted to share with you how we view student loans because I get that question on a daily basis is that going to be something that's going to be a hurdle that I can't overcome for home ownership? Now, if you're actively in a savings plan right now or like an income-based repayment program, and let's say you have $75,000 in student loan debt and you're paying $250 per month, well, we can use that payment right away from a qualifying perspective. Where it gets a little trickier is our clients that are in forbearance just because of maybe litigation, the student loan litigation that's out there, or maybe you're back in school and you're on a deferment. In that case, each program has a different measurement of student loans. So on an FHA insured loan, it's 1% of the balances that we use for qualifying the payment. I'm sorry, on FHA loans, 0.5%, which would be half of that. So it'd be $375 for the payment. For a conventional loan, it's $750 on a monthly basis. So those are the calculations we look at when it comes to looking at those expenses, because in lending, we look at your total expenses versus your pre-tax income on a monthly basis. And that's called debt to income ratio. We're going to spend some time talking about it a little bit in tonight's class. Because it is one of the measurements we look at for qualifying. Doesn't necessarily drive affordability, but we do take a look at debt to income ratio because it is part of some of the underwriting guidelines that's attached to each one of the products. And we're going to talk about programs right now because there's a lot of programs that are out there for you, but it's our job to obviously give you the tips and the resources on what products can match up best for your financial situation and see how they can benefit you on that path towards homeownership. So we'll start first with the conventional loan. That's for Fannie Mae and Freddie Mac loans. That for a first-time buyer has a minimum down payment of 3% of the purchase price. And there's a conforming loan limit that is set by FHFA every year. And that's based upon cost of living numbers across the country. In 2026, that conforming loan limit is 832 $750. So that's in every market across the country. Now, if you're in a high cost of living area, let's say you want to buy in Arlington, Virginia, well, that can go up to $1,209,000. And so that's called a high cost of living area. But with those high balance loans, when we go over the conforming loan limit, the minimum down payment jumps from 3% to 5%. Okay. And with a conventional loan, when we think about conventional, that's Fannie Mae and Freddie Mac. You might hear them in the news a lot because there's talk about privatizing them, or not necessarily privatizing, but even dissolving them. And so they originate about 60 to 70% of all mortgages across the country. So it's a really important resource for us in the lending world. On next product is an FHA loan. FHA stands for the Federal Housing Administration. Minimum down payment of 3.5% with a minimum credit score of 580. The loan amount is structured a little bit differently because it's based upon the county that you're going to buy in. FHA does have lower credit score requirements. It does give us a little bit more flexibility than, say, the conventional loan. It's certainly an alternative that's available to us as first-time buyers. It's not a designated first-time buyer program because you can do conventional loans, FHA, USDA, even VA loans as first-time buyers. So there's no, limitations for you there. Now, FHA is a government insured loan, and just about 7 months ago, there was some residency requirement changes made to both FHA as well as USDA. So you do have to be a permanent resident with both of those programs because they are government insured programs. So unfortunately, those changes were made. And with USDA, it's essentially a product that allows clients to purchase in more of a rural market. The benefit there is it's a zero down payment option, 620 credit score, so slightly higher than FHA. But it's going to allow clients that want to purchase in one of those rural markets that meets not only the designation or location, but also the maximum income qualifying by household. And we'll see varying loan amounts depending on where that property is located. And then for our veterans that have eligibility, there's the VA home loan. Zero down payment option. You can see the minimum credit score. A lot more flexibility for our veterans to have that access to home ownership. It's a great opportunity for the veteran to be able to utilize their VA eligibility to purchase a home. And then I didn't want to forget the jumbo home loan product. That allows clients to purchase that maybe need a little bit more financing power. It's not typical for first-time buyers because it has a higher down payment requirement of 10 to 15% of the sales price. But it's generally for clients that stretch beyond maybe the Fannie Mae and Freddie Mac loan limits. All right, before we dive into PMI, I just want to just do a quick little check-in with everyone. Any questions that I can cover here for you while we're getting ready to go into PMI or private mortgage insurance? And if you have any questions, feel free to use the chat or the Q&A. I have both windows up, so I'll check those out for us. Well, let's keep it moving, and then you guys can certainly ask questions as we go through the rest of tonight's content. Let's talk about PMI because I get a lot of questions around that. PMI is essentially insurance that protects the lender against default by the buyer. So if the buyer had an economic hardship, was unable to make their payments, and defaulted on their mortgage, the lender is protected. Now, there's two forms of mortgage insurance depending on the type of loan product. There's a conventional loan that's PMI, so that's private mortgage insurance. There's about 7 to 8 companies that offer private mortgage insurance. The other side of our slide here is FHA mortgage insurance. So that's government insured loans or government backed insurance. There's different calculations for those types of mortgage insurance. So on a conventional loan, there's 3 elements that make up your cost of mortgage insurance. That includes how much you finance, what your down payment looks like, and then what your credit score is. So the higher I can push my credit score, the more money I can put down, the lesser my mortgage insurance costs are going to be. Another benefit with a conventional PMI loan structure is I do have a cancellation option that when I have 2 years in my home and I have 20 to 22% equity, I can apply to have that mortgage insurance canceled. So that's a big benefit there. If we were to look at the example on screen, someone that's buying a $250,000 home, puts 3% down with a 740 credit score, you can see the PMI is about $85 a month. Okay, so pretty reasonable. If you jumped on sites like Zillow or Redfin and maybe use some of their calculators, you'll probably find a higher mortgage insurance number that comes back in those calculators. And it's really attributed to these elements not being really a part of that calculation. It's more of just a general number that they give you. So I would encourage you to use some of our calculators on our site. We're going to spotlight those tonight so you can find ways to get connected with some numbers that actually look a bit more realistic. Now, on the other side of it, it's an FHA loan. Now, as we mentioned just a little bit in our product segment, that is a government insured loan. There are 2 elements to mortgage insurance on an FHA loan. There's monthly mortgage insurance, which is 0.55% of my loan amount. And there's also upfront mortgage insurance. So there are all those two factors. Now, regardless if I have a 700 credit score or a 620 credit score, I'm still paying the same rate of mortgage insurance. And FHA does not have a cancellation option. Really, what we're going to use FHA for primarily is a short-term solution for us to get access to home ownership. Maybe I've elected FHA because I have a slightly lower credit score or maybe a higher debt to income ratio. But as those things improve in my financial profile, then we want to certainly look to refinance over to more of a conventional loan. So you can see the FHA calculations here. It's going to be a little bit more expensive in terms of monthly costs. And of course, the big one is we do have to add that upfront mortgage insurance to the loan amount. All right, now we're going to talk a little bit about income. I just want to give you a few things to think about when it comes to qualifying income for home ownership, because I get a lot of questions on when am I eligible? Does my income fit? And there's a lot of misconceptions out there in the marketplace when it comes to eligible income. So let's kind of walk through it. And before we do, I did want to pass along some of the general documentation we need around income. So you can see that kind of on screen, that we're going to verify the last couple of years of W-2s, last couple pay stubs, all those things, depending on what type of job we have. Now, in lending, there is a 2-year rule that I have to verify a 2-year span of time. But that does not mean I have to be on the job for 2 years. I just have to look at the last 2 years of it, and that could include education and my time on the job. So if I graduated from Oklahoma State in the fall and I just started my new job January 1, I can technically still use that January 1 starting date for that job to qualify for my mortgage. So I don't have to be on the job per se for 2 years. I just have to show work and or educational history for the last 2 years. All right. So I get that a lot, question a lot from clients. Now, if I'm self-employed, I'm an independent contractor, I get a 1099, whatever the case may be. Then in that case, I do have to show that I filed 2 years consistently of tax returns in order to use that income for qualifying purposes. If I'm a W-2 employee and I have a variable compensation component like bonuses, maybe restricted shares of stock, overtime, then in that case, I do have to show that I've been on my job for 2 years, because what an underwriter does is they take that variable source of income and then they average it over 2 years to determine like the consistency of that source of income. And then if I have two jobs, let's say I work in the healthcare industry and I work for two separate clinics, if I wanted to count both sources of income, then I have to be on both jobs simultaneously for the last 2 years in order to count both sources of income. Last thing I wanted to share with you is around other sources of income that are not going to appear on your application. Meaning, let's say you're going to apply individually, but your partner contributes to the household income, but they don't plan on being on the application. In order to count that income for qualifying purposes, that partner would have to be part of the application, even though they're contributing to the household expenses. Last thing I want to touch on, because it does come up quite a bit, is if I'm working a full-time job and let's say I drive for Uber or Lyft on the weekends and I want to count that Uber and Lyft income, well, Uber and Lyft pays you by 1099, so it's going to show up as a Schedule C sole proprietor income on your taxes. So as long as you've been doing both sources of income for 2 years, then we can average the Uber or Lyft income, for example, over the last 2 years of reportable income to the IRS. Now, as we kind of calculate income and figure out what we can use in qualifying for lending, we compare that to expenses. And those expenses are generally expenses that appear on your credit report, things like credit cards, student loans, auto payments, even the new mortgage payment that you're going to have on the new house, which would include the principal and interest of the mortgage, property taxes, homeowners insurance. Maybe I'm putting less than 20% down and doing a conventional loan, so I have mortgage insurance, or maybe I'm buying a condo or a townhouse and I have HOA fees. So those all go into the expense line. And then we compare that to your pre-tax income. And we give an example here on screen, which is, someone that's paying a $2,000 mortgage payment, they have $500 in debts, and they make $8,000 a month. The debt to income ratio calculation tells us that their basic expenses consume 31.25% of their pre-tax income. That's a good number. The guidelines for financing allow us to go up as high as 45, even 50% for debt to income ratio. The sweet spot for most first-time buyers is somewhere around 33 to 36%. That's where we see where everything feels pretty comfortable for clients. But everybody's situation is a little bit different. You may have other sources of income that we can't be identified in your application, or maybe you're buying in a high cost of living area. Those are things that can kind of move the needle with debt to income ratio. I do think at the end of the day, it's really about affordability for our clients. So while your debt to income ratio may be well within qualifying I think it's important to have a conversation about what does affordability look like for me? Is it the $2,000 mortgage payment? Is it the $1,500 mortgage payment? Those are examples that we'll kind of walk through, or scenarios that we'll walk through as part of your virtual consultation for you. Our last stop in building a home buying plan before we kind of talk about the process is savings for home ownership and just really the down payment resources you can pull from. This tends to be one of the bigger challenges for some of our first-time buyers. Now, we'll talk about assistance programs available in your local market in just a couple minutes, but when we think about where we can draw funds from, acceptable sources for down payment would include obviously checking and savings account, but we can't use cash that's being deposited because every asset has to season at least 60 days in a mortgage. Now, you can also look at 401ks, 403bs, brokerage accounts. I would just encourage you to talk to your financial or tax advisor because we want to make sure those don't impact you financially, whether from a tax penalty perspective or just taking equity appreciation out of the market. Gift funds can also be used. That's where a family member is helping contribute towards your out of pocket to purchase your home. There is no seasoning requirement for gift funds, but we do have to kind of paper trail where those monies come from. All right, so that gives you kind of an idea of how we think about validating down payment resources. Now, as I mentioned, savings can be a challenge for homeownership, and there's a variety of different reasons on why that exists as a challenge. But ultimately, it comes down to a lot of our clients that I work with are maybe new in their careers and just trying to get their financial footing. And so I think implementation of a savings plan like I have on screen can be really helpful for you. It's a really simple approach, but we've had several clients that have acted in with this type of structure and really have got themselves closer to on that path towards homeownership and or have gotten the keys to their home and now are existing homeowners over the last couple of years. So here's how our approach would kind of look at, which would be if I'm paying $1,500 a month in rent, but I go through the consultation process with you and we realize that, hey, I can afford $3,000 on a monthly basis. I just haven't built up that nest egg for savings for my down payment and my closing costs. What I would tell our client to do is let's start paying on the first of the month into our savings account like we're making that mortgage payment. So I pay $1,500 to my landlord, that's out the door, right? But then I create that discipline for myself that another $1,500 goes right into my savings account. And it does a few things. One, as we know, it's going to build our savings account. So after 6 months, I have $9,000 in there. After a year, it's at $18,000. But I think also it gets us accustomed to making that $3,000 mortgage payment so it doesn't feel like such a big leap into home ownership. I've already been doing it for the last 6 to 12 months or whatever time period we need to save up. So, I think that's a really simple way of saving towards home ownership, but really effective. And I can't tell you how many people we've had be really successful with that type of approach. Now, first-time buyer programs can also make home ownership much more of a near-term goal. So I hope as you leave class tonight, it's not thinking, okay, gosh, it's 2 or 3, 4 or 5 years from now for our home ownership. Assistance programs can also make this a near-term goal for you. So in Oklahoma, we have the Oklahoma HFA program, up to 3.5% in assistance funds that can be used towards both your down payment or closing costs. Also some interest rate reduction opportunities with a program like that, and special incentives for teachers and first responders, as well as some of the state employees in Oklahoma. So really great option for you there. Within APM, we have the Pathway DPA program that provides up to 3.5% to 5% of your sales price in assistance. It is only available with FHA. So something just to keep in mind. And we do have the 1% program, which is basically a Fannie Mae program that allows clients that make less than 80% of the median income to get up to 2% of their sales price in assistance that is a grant as long as they contribute 1% of their own money. So as you learned this evening, 3% is the minimum down payment for a conventional loan. You contribute 1%, we'll grant you 2%, I believe up to a maximum of $4,500. So it would be a great opportunity for someone that's purchasing, say, a $200,000 home in Stillwater. They have a $200,000 purchase price, they contribute $2,000, they get a grant of $4,000 to make up the full 3% requirement for the home purchase. So a lot of great tools that are available for you. So, and they're not just obviously based in Oklahoma. So wherever you're thinking about purchasing, there's generally first-time buyer agencies available called housing finance agencies. We can talk offline about some of the different community opportunities that you have or resources available in your community. We can get you connected with the right agencies that can help you with that. But that's something we kind of specialize in as we work with our clients across the country. Well, last stop in tonight's discussion is really probably one of the most important discussions to have is like, where do I go from here? What's the buying process look like for me? I have all these great tools now that are available to me. Where do I go from here? Well, after tonight's class, I love to be able to get connected with you for our free consultation. That's a 30-minute video session I do with all of our clients across the country, whether they're in Stillwater or Amarillo, Texas, or Sacramento, California. We are helping kind of provide you tools and guidance to homeownership. That 30-minute session allows us to build that plan for you. Now, you may not be looking to purchase in 2026, but you want to set some goals and objectives for buying later on in 27 or 28. That's what you can do through a free consultation with us. Now, if you're looking to purchase this year, we will issue a pre-approval, assuming you're eligible, that allows you to start actively shopping for homes, whether it's in the spring or summertime, whatever your timeline looks like. A pre-approval is good for 60 days, but can be easily recertified at any time. Now, you have some steps to start the consultation process, which I'll walk you through in just a bit, but ultimately, that consultation will give you the game plan for homeownership and then issue that pre-approval. As we move down the buying process, step 2 is kind of one of the more favorite things to do, which is start the home shopping, right? It probably starts online, where you're on Zillow or Redfin or whatever site that you're looking at homes. I would encourage you to connect with a local realtor in your community. We have our preferred network of realtors that we can introduce you to as well. So you'll generally kind of identify or bookmark a couple of listings that you really like. And then eventually you'll kind of go out and look at those homes or attend open houses. That process tends to be the longest process, would be the home shopping side of things. But we're here to help support you as you go through the home shopping, because you might have different scenarios you want to run by us, or talk about the interest rate, or just look at a various scenario. We'll help you through that as you go through step 2. Now, once you identify the property you like and you submit an offer, that offer might get accepted or it might not. But let's say, for example, that offer gets accepted. Well, then you're going to move to step 3 in the process. That's called entering escrow. So that means the seller has accepted your offer. And in the contract that you've agreed to with the seller, there's terms and conditions of that contract. It says when you're closing escrow, you have an investigation period to get inspection reports done. Those are called contingencies, which we'll talk about in just a second. But there's different kind of requirements for you as the buyer once you go under contract with the seller. But the day we get advised that you're under contract with the seller, you're going to get a call from me saying, hey, congratulations, your offer is accepted. Let's get you scheduled for a follow-up video session so we can take about 30 to 45 minutes, go through all the important elements of your financing. Let's talk about the rate environment, maybe what assistance programs you're looking at, and then we'll set a kind of a timeline of events for you with your home purchase. Now, within a couple of days, you'll also be required to make an earnest money deposit for your home purchase. It's essentially a good faith investment that you're making into the house. It shows the seller that you have a financial stake in the success of this transaction. That earnest money deposit, depending on where you're buying, is usually somewhere around 1% to 2% of the total purchase price. And that money will be held with a title company, escrow company, or an attorney, depending on what state that you're going to look to buy in. Now, most parts of the country have what we call contingencies inside the contract, which basically there's timelines for certain things that need to be performed on the property, like getting the inspections done, getting your loan approved, and getting your appraisal done. Your realtor will help with the inspections and organizing what inspector will come out. And then, of course, our team will help with the loan approval as well as getting the appraisal sent out and getting that report back for you. But why the contingency is important is because your deposit is protected within that timeline. So as we move through the process and get some of these reports and these outcomes back in, you know that you have kind of the security that your deposit is not at risk. Now, step 4 takes us to the administrative process. That's more of the employment verification, asset verification, loan structure. And then we're going to submit to an underwriting team that will take us to step 5, which is the underwriting process. Now, one thing I just want to make is kind of a side note here, because especially in the market, we've talked a little bit about interest rates. Interest rates change by the minute during the trading day on Wall Street. And so when the market opens up, we'll see interest rates kind of fluctuate. Once you're under contract with a seller, we're going to talk strategically about the timeline of locking in your interest rate. So there's a little bit of an art to that. And, we have a pulse on what's happening with the market at all times, because it's up on our dashboard. And that's one of kind of our value adds for our clients, is just making sure we try to seize every opportunity in the market. Now, as we move through the various stages in the loan process, you are getting electronic disclosures sent to you. After we get a chance to meet for your follow-up video session, which happens just right after step 3, you're going to get disclosures sent to you. Once we lock in your interest rate, you get another set of disclosures. And step 5 gets us to the loan approval stage. We're not only getting your loan approval, but we're also issuing your final closing disclosure, which gives you a 3-day cooling off period before we get to the very final stage. And that's called this closing of the loan. where you're essentially signing final loan documents with an attorney or a title officer. That same day, you're going to deliver your final funds for closing. Most parts of the country, it's what we call table funding. So the date you sign your loan documents is the same day you bring your funds in, we wire the loan funds, and then you get your keys that day because things will settle with the county recorder's office for the transfer of ownership. Other states, like say California, for example, you'll sign on one day, you'll fund and close the next day. All right. So once we get word that everything has been recorded with the local county recorder's office, then I get a chance to make my favorite call of the day. And that's to say, hey, congratulations. You are now a new homeowner. Best part of my day by far, where we just get a chance to celebrate with you. It's a huge accomplishment, major final financial milestone for you. And most of those relationships have started right here in class like this. But our relationship doesn't end when you get your keys to your house. We have our aftercare program. So whether that's watching interest rates to see if we can seize a refinance opportunity, or just checking with you with you on an annual basis to see how you're doing financially, or leveraging some of our tools, we want to make sure that our relationship is ongoing. We're going to provide you tools like our HomeBot system to help you manage your home equity position, our rate watch system to, like I said, watch kind of what's happening from a interest rate perspective for you. So if you're thinking about moving forward in the home buying process, whether that's this year as a financial goal or in the next couple of years, I'd love to be able to partner with you on that journey. This is our get started information here. You would complete a really simple online application. We only do a soft credit check, as I mentioned earlier during our credit segment. You would upload proof of your income documents, asset statements if available, and then you would use our scheduling system just to schedule your virtual pre-approval consultation. Really simple process. And that 30-minute session really gets us an opportunity to really understand how we can best support you in that journey towards home ownership. If you have questions after tonight's class, I know we haven't got a lot of questions that have come in, but if you do have specific questions or a scenario you want to run by me, please schedule an introductory call. We'd love to be able to meet you and just kind of see how we can help provide any type of more information for you in home ownership. This is kind of what our consultation service looks like, very similar to all the concepts that you learn in tonight's class. And I mentioned to you some of our calculators that are available to you. Those are on mobile. They're also up on our website as well too, whether that's an affordability calculator, the rent versus buying, or just simply just to understand a monthly payment. We try to really embrace technology, whether that's through AI or mobile tools. It doesn't at the same time replace the human side of our business. There's a lot of expertise and support and just readiness that comes along with helping you in this journey towards home ownership. So whether it's a text, a call, email, we want to make sure we're on standby to always help you in this home buying journey. As we finished out tonight's class, I just want to spotlight for you. We also discount our services for you as part of our Oklahoma State partnership. So you get discounts and closing costs. Of course, you have access to all of our workshops that we provide and all the recorded versions online. But we want to make sure that we take care of you as part of one of our members of the alumni community. We also have other partnerships across the country. So if you've enjoyed tonight's content, please share that with your friends, family, or coworkers. We'll teach over 10,000 future home buyers home ownership this year, and we're proud that you got a chance to spend a little bit of time being a part of that group to be able to learn more about what it looks like to achieve and how to get to home ownership. Here's my contact information, so if you want to reach out to me after tonight's class, please feel free to. And on our socials, we love what our clients say about us. It really is a testament to how hard we work for our local communities in affordable home ownership, whether that's the commentary in Reddit communities or just testimonials on Google reviews. And our socials on Instagram, we're trying to put a lot of good content out there. So feel free to check us out on our socials. And then, of course, we'll have tonight's class up on our YouTube channel tomorrow for you to reference back to. All right. Well, I saved us a little bit of time. We're about 10 minutes inside of the hour. I want to answer any questions our class has. I do appreciate everybody kind of standing by. Those that you had to kind of leave class for a little bit, no big deal. But any questions we have for tonight's class that I can cover before we wrap up our session? I know, and many of you in the time zone that we're hosting this class in, you're getting ready for dinner right now. So you're like, I know that's a tough one to compete with if you I got dinner in front of me here. All right. Well, I think we're good. Let me just do a quick little double check. I think we got through. I don't see any questions whether in the Q&A or in the chat. So with that said, I do appreciate everyone spending some time with us tonight. Hopefully you had a few things to take away from tonight's discussion. I hope I get a chance to meet each of you for your own consultation soon. Have a wonderful evening, and I wish you all the best. Have a good night.